All right, now we're going to talk about finding the free money. So here's what you will learn. You're going to understand the concept of working capital, and you're going to see the source of free money and which sectors have the most. So we are going into a little bit more detail into the liability section of the balance sheet. And first, we're going to talk about working capital and net working capital. Sometimes working capital is defined as current assets minus current liabilities. Sometimes this can also be called net working capital. Another more narrow definition is current assets excluding cash and current liabilities excluding debt. Now what follows is my definition of working capital and net working capital. So let's look at it in more detail. First, we have current assets. We know they're cash, accounts receivable, inventory, and others. And if we exclude cash, the remainder could be called working capital, and that's what I call it. Working capital is the assets of this calculation. It's accounts receivable, inventory, and others. And the current liabilities, excluding borrowing, are accounts payable and other current liabilities. So the calculation of net working capital is when we net out the current liabilities from the working capital. So here's the calculation. It's just we add up the accounts receivable, inventory, and other current assets, and we subtract the accounts payable and the other current liabilities. So the liabilities portion of the net working capital calculation is sometimes called spontaneous liabilities. These are short-term liabilities that occur from just doing business. Examples are salaries payable and accounts payable. For instance, if you hired someone and they're going to work for a month, you don't pay them on the day that they start working, you pay them at the end of the month. And you are getting a salary payable, meaning they're giving you some value, and you're able to make money off that value until you have to pay them. So the spontaneous portion of net working capital is the portion in red. It's the current liabilities excluding short-term debt. Let's look at some examples of high net working capital companies. Companies that require a high amount of net working capital are those that cannot fund all their short-term assets with short-term spontaneous liabilities. So if we look at the calculation of working capital, these are the assets, or we could even call them spontaneous assets, but I don't call them spontaneous assets because I want you to think about these as strategic assets. These are the strategy that you're pursuing in inventory, in accounts receivable. And that's the reason why I don't call the assets spontaneous assets. So imagine a company has working capital, that's the asset part of this formula, minus spontaneous liabilities of 60. That means they have a net working capital need of 40. In other words, let's just simplify it, really simplify it, and say this company gives accounts receivable, they give credit to their customers of 100, but they only receive credit of 40. The gap there, money has to come from somewhere, and usually it's long-term funding that fills this gap. It could be long-term or short-term funding, since I have excluded short-term funding from this. So let's look at a diagram of how this would look. In this case, what I'm showing is a high net working capital company. And what you can see is, in this case and the next ones, I'm going to keep the asset side of the balance sheet the same. You're going to see accounts receivable, inventory, and other current assets. And then you're going to see cash and long-term assets. So I've moved cash down from the current liability section into the long-term. And on the opposite side, on the liability side, you're going to see accounts payable and other current liabilities. I've moved the short-term borrowing down to be included with other long-term funding. And the result of this is, if it's a low spontaneous, if it's a high net working capital company, it means it has a low amount of spontaneous liabilities. And let's look at a low or zero net working capital company. Companies with low or no net working capital needs can fund almost all of their short-term assets with short-term spontaneous liabilities. So let's go back to our calculation, and we can see the working capital, meaning the assets, minus 95, meaning the spontaneous liabilities. There's just a 5 net working capital need in this case. Long-term funding, as well as some of the short-term funding that we accumulated in the diagram below, can fill that gap. Now, there are some companies that have a perfect match between their their working capital and their spontaneous liabilities, and they would be zero net working capital companies. Let's look at one. Here would be an example of a company that has current assets excluding cash, we call this working capital, minus spontaneous liabilities excluding short-term debt, that equal each other. Now let's look at the next one. It's less common, but companies with negative net working capital can finance more than short-term assets with short-term liabilities. So let's go back to our formula, the assets minus the liabilities here, and we can say 100 minus 130 equals negative net working capital. So they need less long-term funding because excess spontaneous liabilities cover a portion of what normally would be funded by long-term debt. Now, net working capital can be used to finance a portion of long-term assets. In this case, these companies are very lucky. They get a lot of credit, and they can use that credit to finance the core assets. And that's what you can see here. When you see the diagram, and particularly the liabilities portion, the upper portion, you can see accounts payable and other current liabilities is very large. That means that those spontaneous liabilities can cover more than the current assets of the business, and therefore they can fund part of the long-term assets. So I'm going to tell you a story about a company like this. So my business partner Dale talked to me about a prospect that we had in Thailand. And we've talked to many companies, and we talk to them all the time. And this prospect happened to be 7-Eleven, and that's a company called CPO. And basically, and of course, they're a huge company with a huge number of branches, and they want to buy machines. We're competing against many other suppliers, including they have their own supplier related to that group. So it was questionable whether we would win this or not. It was very, very competitive. So what I decided to do before we went into the discussions and meeting with them, I found their financial statements, and I'm going to show them to you. These are in baht terms, not US dollars, but baht, and in billion baht terms. And we can see they have cash of 31 billion baht. That's $1 billion. They have accounts receivable that are tiny because it's 7-Eleven. They don't give credit. And they have inventory of 32, a relatively large amount of inventory, but they have 7,000 branches. They need the product to be on the floor. Then I looked at the liability side of their balance sheet, and I saw overdrafts, so they have a small amount of borrowing of 16, but I saw this accounts payable of 94. Wow. They have accounts receivable of 9 and accounts payable of 94. If we wanted to calculate the net working capital calculation, we could add the accounts receivable, inventory, and other current assets, and that would come up to 41 of working capital. And if we netted out the accounts payable and the other current liabilities, we'd end up with net working capital of 56 negative. What does it mean when a company has negative net working capital? It means that as they grow, they actually generate money. If a company has positive net working capital, it means that as they grow, they cannot finance the current assets of their business. They need to raise more capital to finance their growth. But if it's negative, the actual act of growing generates cash. Now, in this case, I knew that they demanded very long credit terms. It could be 60 days, it could be 90 days. We were a tiny company, and we didn't have access to funding, and it was likely that if we went into a deal with them, it could possibly sink us because we couldn't finance the growth and demand that they had for machines. Now, of course, if we could get access to bank loans and some other things, we could decide that we wanted to do that. But in the end, we lost this deal. When we lost this deal, part of it was the idea that we felt like the financing aspect that was going to be required by our customer was very, very high, and we felt that we may not be able to meet that. So that gives you an idea of a negative net working capital company. Let's go into our sectors and look a little bit more here. So I'm just going to look at the global 18-year average, and these are in percentage terms, right? So we can see accounts receivable are 13% of total assets, inventories 8%, and other current assets 3.3%. And so we end up with working capital of 24.6. Now, we're looking at a common size statement, but you could really think of it in dollar terms if you wanted to. The next thing we would do is look at the accounts payable, and we would subtract those, or let's say first we'd add them up to say what are our spontaneous liabilities, and in this case it's 20.3. And then finally, we would subtract the working capital from the spontaneous liabilities from the working capital and end up with 4.3. And that tells us that the average company over the last 18 years has not had enough spontaneous liabilities to finance all of the working capital. And the result of that is that they have to finance part of that by borrowing money or from equity. Now, what I'm going to show you here is, let's look at the working capital for a moment, and we're going to look at each sector. The highest working capital is at real estate and industrials. And the lowest is at communication services and utilities. Why? Well, we know for communications and utilities, they don't have any accounts receivable and they don't have any inventory. Now, let's look at the next item, which is spontaneous liabilities. So they're highest also at real estate and at industrials. And what we can see is that they're lowest at utilities and materials. So spontaneous liabilities at materials is only 15, very low. Now, let's finally look at the net working capital by sector. And what we're going to see is that it's highest at real estate at 20 and materials at 10. So real estate is extremely high. And it's either negative or zero, negative at communication services, and it's zero at utilities. So negative at communication services basically means they just don't have that much current assets. Look at the inventories. They're down at 1. All right, so they're tiny, and other current assets also. And net working capital is low at consumer staples and at energy at 1.8 and 2.1. Makes me want to sip on some great coffee works. Feeling good. All right. So let's go back. Remember in the prior section, we didn't break down liabilities into too much detail. Let's review what we did. In the prior section, we looked at liabilities and said that there's a 60-40 split, that 60% liabilities, 40% equity. Now, when we look at the current liabilities and long-term liabilities, the question that I asked back then and that I wanted you to think about is this all debt, meaning borrowing? Well, let's look at the types of capital. Capital is generally referred to as money supplied to a business that's either earning interest or dividend. So that includes both debt and equity, and we call that capital. Now, for something like salaries payable, the company is essentially borrowing from employees, but not paying interest. Hence, it's not capital. Capital is something that demands interest or dividends in the case of equity. Now, we often use the term interest-bearing liabilities to refer to the debt portion of the liabilities section of the balance sheet. So the question you have to ask yourself is this interest-bearing liability or not? And this is how we find the free money. Now, we now know that the average company has financed its total assets of 100 with equity of 40 and liabilities of 60. But are all of those liabilities interest-bearing? They're not. Only debt is interest-bearing. So if we subtracted debt from the total liabilities, the result will be non-interest-bearing liabilities, or what I call free money. So let's do this calculation by sector. So let's go into our sectors, and we're just going to look at the total debt and the total equity, and that gives us our total capital. So debt of 28, and remember that's short-term debt and long-term debt for all companies, and total equity is 40, we've already seen that, and so the total capital is 68. That means, because we've rebased it to 100, and it's a common size statement, that means the difference is 32. 32 is not equity, and it's not debt. So I call this free money. It's non-interest-bearing liabilities. And let's just look at the consumer discretionary sector. It's got 30 in debt and 38 in equity. It's got the same 68 in capital. It's just a little bit different mix, and they've got 32 in free money. And we can look at the rest of the companies in the sectors. Let's look at total amount of debt. So debt is highest at utilities and real estate. And what we can see is it's lowest at infotech and energy. Now let's look at the free money aspect. What we can see that it's highest free money at industrials and real estate, and it's lowest at materials. So we've now gone through a little bit deeper into the liabilities section of the balance sheet. Let's review what you have learned. You've learned that working capital is accounts receivable plus inventory plus other current assets and excluding cash. Net working capital nets out spontaneous liabilities, which are accounts payable and other current liabilities. So we exclude debt also. Net working capital is positive for all but two sectors, though some companies have negative working capital. In fact, I showed you a company that had extreme negative working capital. Positive net working capital means spontaneous liabilities are not enough to finance all the working capital. Remember, when I refer to working capital, I'm talking about assets. Negative means the company generates cash as it grows. Net working capital is highest at real estate and materials. It's negative or zero at communication services and utilities. And it's low at consumer staples and energy. And the highest free money is at industrial sector and real estate. And the lowest is at materials. Think about real estate. Remember, we saw that many people purchase their home or that type of thing with a down payment. And it's that down payment that's actually financing a portion of the balance sheet of real estate companies. So, congratulations. A tip of the glass to you. A tip of champagne, though I don't drink champagne. I do drink coffee, so I'm going to tip my glass. So what's next? Well, you're going to understand the nature of equity and why companies choose to buy back their shares. I'm excited for this one. I'm going to tell you a little story, and you're going to learn from it. So I'll see you in that section.
I had no idea that I would be able to create something like this in 6 weeks.
It's either I go back to audit and call it a day, or I can try to become CFA. And really, this course is giving me all sorts of motivation to actually study for the exam.
They don't teach this kind of stuff in school. In school, it's just theory, and theory. But here, it's real practical knowledge, something applicable to life. So I thought that was really useful.
I really, really enjoy doing the research. And for me, it's something that I'm going to continue with as much as possible. So it's given me another thing to do in life, really.
I learned, very structured way of thinking, and how I process things would change.
Andrew, we're going to miss this so much.